UK benchmark bond yield rises to 1% for first time since March 2020. A global slide in government bond prices continued on Tuesday, pushing the key medium-term UK bond yield to 1% and knocking European equities markets and Wall Street stock futures. The UK 10-year gilt yield climbed 0.04 percentage points in early London dealings to 1%, a level it has not hit since the market ructions of March 2020. Gilts have not regularly traded at that level since before the onset of the coronavirus crisis. To stay up to date with latest top stories, make sure to subscribe to this YouTube channel by clicking the button above this video. The yield on the 10-year US Treasury note, which acts as a benchmark for borrowing costs for companies and households worldwide, added 0.06 percentage points to a three-month high of 1.54%. Rising government bond yields, which investors use as a barometer for assessing the relative value of Stoxx dividend payments, pushed the Stoxx Europe 600 index 0.8% lower in early dealings, with technology stocks leading the falls. London's FTSE 100 dropped 0.4%. When bond rates go up, it makes equities look less attractive, and particularly those whose dividend yields are very small, such as in the technology sector, said Rebecca Chesworth, senior equities strategist at State Street Global Advisors SPDR ETF Business. Contracts that wager on the direction of Wall Street's Nasdaq 100 indicated the tech-heavy index would drop 1.2% in early New York dealings. Those on the broader-based S&P 500, which also has a high concentration of tech shares, fell 0.7%. The 10-year Treasury yield has jumped from around 1.3% a week ago, driven higher after the Federal Reserve last week said it was ready to begin reducing its $120 billion of monthly bond purchases that have boosted lending, spending and debt and equity markets throughout the COVID-19 era. The world's most influential central bank also revealed that half of its monetary policymakers expect the first post-pandemic interest rate rise next year. Last week, the Bank of England also warned that UK inflation could top 4% into next year, sparking expectations it was moving closer to raising interest rates from their current record low. Nervousness also crept into stock markets ahead of the US government's latest battle to increase its borrowing limits. On Monday, New York Fed President John Williams also warned that a failure by US lawmakers to raise the government's debt ceiling could cause a very negative dynamic for Treasury markets and beyond. This looks likely to be resolved, but every time it happens, there are always jitters about it, so it becomes a reason for short-term money to stay out of the markets, Chesworth said. German bonds fell in parallel with treasuries, the yield on the 10-year Eurozone benchmark bond rising 0.04 percentage points to minus 0.189%, the highest since early July. The dollar index, which measures the US currency against six others, inched 0.2% higher to 93.6 points, its strongest level in more than a month. Brent crude, the international oil benchmark, rose 1.4% to $80.67 a barrel, a level not reached since October 2018, on track for its sixth consecutive day of gains. Oil traders expect a resurgence of fuel demand as the travel industry recovers from the pandemic shock, while Hurricanes Ida and Nicholas, that battered the U.S. Gulf of Mexico in August and September, have curtailed U.S. production. Analysts also expect a surge in natural gas prices in Europe to prompt electricity companies to switch to oil for power generation. In Asia, Hong Kong's Hang Seng Share Index rose 1.2% as real estate stocks rallied. On Monday evening, China's central bank appeared to respond to the unfolding debt crisis at Evergrande, which missed an interest payment on bonds held by foreign investors last week, with a pledge to safeguard the legitimate rights and interests of housing consumers.